what's going on, cash flow hackers? It's Chris with Life 180, and I've got Todd and Kim with Truth Concepts here today. And we are continuing the series. And after our last video, we had a conversation about this whole opportunity cost concept and the fact that I feel like, well, Todd actually brought it up at first, but I feel like the opportunity cost thing comes up probably more with our cars, our automobiles, than any other place in our life, because we all buy cars. Everybody pretty much has to buy a car. We have a tendency of buying cars probably bigger, more expensive, more fancy, more often than we maybe should. I don't want to should on anybody, but like at the same time, I think people do things not because they're trying to self-sabotage or anything like that, but by the nature and the way that they're handling their car buying process, they're self-sabotaging because they don't understand all the numbers, they don't understand the long-term ramifications, because they don't understand this thing called opportunity cost. And so today is going to be really fun because Todd and Kim have their fancy calculators, and we're going to go through all the stuff, and Todd's going to walk through all the opportunity costs that goes into your cars. And I want to say this kind of before we get going, is there's a lot of people, if you go online, there's a lot of people that are selling whole life insurance, selling infinite banking, selling these concepts that you can make money by buying cars, right? And so there's a lot of videos about people saying, well, I'm going to show you how to make money on every car that you buy. And the problem that I have with that, A, is it's not true. B, if you believe that to be true, you're going to make bad financial decisions, and those decisions will have a ripple effect into every other area of your life. And it has the potential to be toxic when it comes to your long-term financial plans. And so in this video, what we look to do is dispel the myth about the fact that you can't make money on buying cars. Cars are absolutely a lifestyle expense, and we need them, right? We need a car. And so how do you, if you're going to buy a car, how do you make sure you do it in the most efficient way possible and understand everything that goes into it? So all that said, the stage is set. I'm going to turn it over to you guys and let you go crazy.
Great. Thanks. Great to be here. And, this is a subject that's, it encompasses everybody, right? We all have to have cars. It's part of life, I guess, unless we, got an Uber everywhere. Maybe if we lived in New York or somewhere, we wouldn't have to have one, maybe. But the point is, and when we go through this discussion, it's all expenses fall in this category, and it's just that cars are a big one. And so it's a good way to open up and look at what's going on. And last time we talked about the idea of opportunity cost being really negative opportunity. It's not a separate thing. It's everybody understands opportunity, and we just need to understand that all cost is negative opportunity, right? It's just interest running the other direction. We can always see it with a loan, but it's hard to see in the real world. And we can get carried away with that, right? We could price out a hamburger or anything that we're doing and say, oh, over 30 years, this hamburger cost you, a gazillion dollars. Okay, that's not realistic, right? There's lifestyle choices that we make. But I think part of it is because of the way things come at us, especially when we look at cars, like how hard is it to buy a car? You walk in, they'll figure everything out. Hey, this is only going to cost you X a month. You have no idea what you're paying for. They just sign here and walk out the door, and it's an easy thing, right? And so people do that, and I love a new car, right? But if we don't understand how big that choice is, it's not to say don't have new cars and that kind of thing, but it's let's look at what the long-term cost of this is. And maybe you'll make different decisions if you know what that's going to take away from you in the future. Maybe not. Maybe you say, cool, I like new cars and I'm willing to sacrifice X amount of dollars in the future. But if you don't know what that is, how do you make that choice?
Well, one of the things that I say all the time is people struggle with money because their money's not in alignment with their values and beliefs, right? Yeah. And the thing is what you just said is you might get through all this and be like, all right, one of my values is I really value a new car. I really value how I feel. I really value like how I feel when I'm a clean, new, high-tech, badass new car. Like I just feel awesome, and therefore I'm more productive. I'm more vibrant. I'm this, I'm that. And you can look at that from a value perspective if that's you. and make an educated decision and be like, all right, I understand that there's a cost to it, but the value that I'm getting is in alignment with my beliefs and what I'm trying to create. And I'm intentionally doing this. That's a whole different scenario.
Well, yeah, absolutely. So think about this. There's been some stuff around. Oh, drive a 20-year-old car. Okay, well, you show up to somebody's office in an old beater and want to sell them financial success. They're going to look out there and say, "Yeah, I don't think so." Right? So there is some value in there in having something that's current and and as far as your production capabilities, right?
Totally.
All right. Well, let's bring up this automobile calculator. And like I said earlier, this could be any major expense. It falls in the same line. It's just that cars are a big one, and for a lot of people, a lot bigger than they really thought they were. And I'm going to make some assumptions here. I'm going to look at the idea of maybe it's a $50,000 car. We're going to finance 40,000 of that, and pretty much every 4 years, it's going to depreciate down to where there's enough left value on it, maybe to do the down payment for the next one. Fair?
Yeah, that sounds good.
Okay. So one of the things that happens out there, and you hear this from lots of financial proponents that are against debt completely, like Dave Ramsey or other people that are just in all circumstances, debt's bad. If you pay cash, you avoid interest costs and all these kind of things. And we're going to look at this in a little different picture. And so what I want to do is I want to say, let's say that we've got somebody that's a good saver. They've got $100,000 currently of assets, and we'll go out 30 years.
Okay.
They've currently got $100,000 of assets. Like I said, they're good savers. They're saving $20,000 a year.
Yep.
And they are tuned to something that all of us ought to be tuned to, and that is, we need to think about our savings from a percentage standpoint, not a dollar standpoint. And that's really important, I think, because what happens is as our income goes up, our savings should go up. And if we're in a place where we're saying, okay, we're going to save 20% of our income or 15% of our income, whatever that number is, when our income goes up, we need to boost that up. And it's not going to totally get rid of the impacts of inflation, but it's going to help some. And I think a lot of times we get into a scenario, or a lot of people do, where they say, okay, it's 20% this year. They take that dollar amount, and that's what we're going to save from now on. While everything's going up in price, you're going to be way behind out in the future. So this is going to help a little bit by increasing that. And so on the savings increase, let's increase that by, say, 3%, just a cost of living increase. And over this time frame, with those increases in savings, we can see $20,000 growing across that time frame. Cumulatively, that's about $1 million over this time frame. But clearly, we also want to earn some interest on this, the idea of opportunity, right? And so if we put in, say, a 5% net earnings rate, what we see over this time frame is going to grow to $2.4 million. Now, we're buying cars. Let's say we've been financing them. We go to a seminar of some kind that teaches us how bad debt is, and so, you've got this cash sitting there. You should finance your automobiles out of that cash because you don't want to pay interest to a lending institution. And it all sounds great. So we do that, and we start in year one. We're going to buy our first car. And again, a $50,000 car, but let's say we've got a 10% or 20% down payment on it. We're going to finance $40,000.
Oh, that's a big car. Hold on. Got an extra zero.
Nice.
All right. So what we see across this time frame is, if we finance this out of there, that one car, that one $40,000 car, it took away actually about $172,000 for that one car over that time frame. So the fact that we took $40,000 out, it wasn't just $40,000 less out there in the future. And you can see we would have had 2.4 million. Instead, we have 2.24 million out there in the future. So that's that $172,000 difference. So basically a $40,000 car took $172,000 away in the future, and we're looking again at just the financing part of it.
So it was a $172,000 car.
Exactly. Right.
You know,
But do we see that? What do you think would happen if you walked into the dealership and they said, "I've got a great deal on this $172,000 car"?
Yeah, right.
Probably not going to do that.
And so the idea there is like Dave Ramsey's story is like you should pay cash for that, because rather than paying, let's call it like in today's interest rates, like an 8% interest rate on the $40,000 car, because if you do that, you're going to end up paying $10,000 to $14,000 in interest maybe in the car over a 4 or 5 year period. You why spend that $14,000? So pay cash when in reality that cash expenditure is potentially costing more.
Right. Well, the thing about it is we never get out from underneath an interest cost, and right. that's what's often talked about in some of these pay off your debt early schemes and other things, is that you get rid of an interest cost. You get rid of an interest payment, but you don't get rid of an interest cost if you understand that we live in this finite world with our finances, where everything we do impacts everything else. And so now that it goes into something that's a little harder for people to get around in their head, and it's the idea of negative opportunity. And that's what's happened here. Right. I have a friend in Louisiana, and they speak pretty plainly, and his comment is, we either pay up interest or we pass up interest. And there's no way around it. We never get rid of an interest cost. When we pay cash, we're just passing up interest we could have earned on that. It's the same thing as paying interest in reverse. So we're not getting ahead. We never avoid an interest cost. Yeah. Nelson Nash used to say, we finance everything we buy, and we do one way or another, either directly with a lending institution or with our future assets. Yep,
for sure. Now,
it's hard to see it when we finance. What's that?
And what do you say to because I look at cars as this. It's a lifestyle thing, and I'm the kind of guy like I'm going to buy a new car probably every 5 or 6 years. This kind of the way I do things. Like because I don't want an old beater car, and really for me it's the peace of mind of not having something going wrong with the car. You know what I'm saying?
Yeah. Let's do every 4 years. That's kind of more common, right?
Yeah, that's fair. And so there's that, but like our cars are a lifestyle expense. And the way I kind of like look at it is it's always about cash flow. Like, cause I look at the whole world through the lens of cash flow. And, if I pay cash for that car, I avoid the interest, but like we just kind of cover the interest, the opportunity cost for it. But at the same time, there's also like the actual cost of the car. Like if you want to buy the car, you got to pay for it. So whether you're, if I pay cash, let's say I have a dedicated amount paying cash for it, I'm going to have to either pay a car payment or I'm going to have to save for the next car. Like you don't get out of you can't avoid the expense on the next car. You know what I mean? And so like the idea that your cash flow is going to be wildly better is not necessarily accurate. Does that make sense?
Oh, yeah. Oh, yeah. And if you don't have a way to put it together, it's just really hard to see what it really costs, right?
Yeah.
So here, I mean, look at this. If we did this every 4 years, our cost for automobiles goes up to $770,000. Literally what will happen is instead of the 2.4 million we had in our sights for that distribution phase of life, we have $1.6 million. So we're taking away $770,000 worth of assets by doing this, assuming that cars don't go up in price across this time frame.
Right. Well, right? Which they will.
What if we had an increase for inflation of, say, I know cars are going up huge amounts, but let's just put 4% in there.
I would say keep inflation with the cars the same way inflation would be with the economy.
Sure. Let's just put 3%. Okay, so now we've got a cost of a little over $1 million. But the reality too here is this is just one individual trading cars every 4 years. In a family with a couple, is that what usually happens? Or do we usually have two cars we're trading every 4 years?
2 cars, for sure.
Yeah, or the same as one every 2 years. Let's say we offset them.
There you go. Yeah,
So
that's
now we're
pretty
talking
good.
about $2 million for cars to buy 2 cars every 4 years, which is, gotten to be a pretty common occurrence. And we've got cars that last forever now. I don't, you probably didn't come from the days like I did where, we used to see cars on the side of the road. Like literally they would stop and, they would be on the side of the road until you got a wrecker to come get them and get them fixed. That doesn't happen anymore. You never see cars on the side of the road. They last forever. They've got computers in them that adjust for different pieces, and they can last a long, long time. And so this idea, and it's not to say don't do this, it's to say, look, understand this system of decisions, and this is with no kids involved, right? No additional cars. That's $2 million of retirement assets to make this choice. What if instead of this, we push this out to every 6 years? And so that would be the same as every 3 years for each car.
Okay.
Sorry. Make it a 3, Kim. Okay, that's $1,351,000. So we basically reduced the cost by almost $700,000 by adding 2 years to each car. And so, I'm not saying do this. I'm just saying this is where we are.
I want to put that in context. The average American hits 65 years old right now with under $300,000 saved.
Right.
So when you look at the fact that everybody's going out, not everybody, but most people are going out and doing this, and they're getting a retirement with less than $300,000 saved, and they're screwed basically when they hit retirement, and they can make this one adjustment and basically triple their retirement savings.
Yep.
All right.
It's small things. And this goes back to the conversation we had earlier. Maybe, for whatever reason, it makes you more productive to be able to trade cars more often. That's a decision you have to make. But if you don't know this huge cost, then it's hard to do that. And if you heard, Dave Ramsey or some of the others speaking, it would be, well, as long as I pay cash, the cars don't cost me anything. No, this is paying cash. This is what it costs you to pay cash for cars. Okay. Now, here's what's interesting. And if we can make this next leap in our thinking, would this be better than paying 8%, let's say, for cars to our lender? And I'll say maybe. So if we analyze this, we, like I said earlier, we finance everything we buy. Well, at what rate did we finance this? We financed it at whatever the net earnings rate on this account is. Basically, it's the same thing as if we'd paid somebody 5% to finance these cars. So whatever the net earnings rate. Now, is 5% less than 8% with our banker? Yes, mathematically.
Yeah, okay. I can't wait to hear you describe this because I go through this. It's like one of my favorite conversations with people. Go ahead.
Yeah. So yes, it is, but not if we don't take that differential and put it back in here. And unfortunately, the message has been, if we do this, if we pay cash, we've got plenty of extra money to do all the other things that we want to do. So the difference in that rate gets blown, and so it never shows up back in somebody's account. So the issue is, yes, doing this and being, quote, an honest banker, and that is taking what we would have paid our banker at 8% and putting it back in this account. Yeah. That would get us ahead. We would actually realize the difference in those rates. The problem is people aren't tuned to doing that, and they don't do that if they don't have a strategy to do it. And at the end is when they figure it out, man, something's really wrong. And just like you said earlier, 30 years from now, we figure out, dang, those cars cost me a lot more than I thought. It's too late to fix it.
Yeah, totally. Now, I don't want to derail this, but I have a question for you on how you deal with this and how you do it in the calculator. And how you have the conversation about this when you're talking to clients, because so let's say I could earn 5% in an account that's going to grow, that's compounding. Let's say that it's a fixed 5% every year, and we know it's going to be there, right? So it's not speculative with the market. It's it's just going to be 5%.
And that's net of taxes.
Net of taxes. Okay. And so we have 5%, and we have the option to either pay cash for that, the opportunity cost, is going to be 5%. We're self-financing at 5%, basically, is what the conversation is there, right?
Right.
And we got to put that money back in. We'd have to, like, in my mind, we'd have to pay that money back, and that's where we were talking before, the cash flow. We still got to pay for that car. Like, we got to put it back. Otherwise, the cost is amplified. But then people go, well, why would I want to go pay 7% with the bank when I have 5% there? But the challenge is, how do you describe to somebody the difference between a compounding interest versus an amortizing debt? Because 7% interest on a debt vehicle where you're paying interest and principal down, the 7% winds up being on smaller numbers every year versus the 5% is on bigger numbers every year. How do you kind of navigate that conversation?
Well, the thing about it is, if you're taking that differential and you have to have a good strategy in place. But if you do, it would be better to finance at 5% if you're taking that differential and you're committed to paying that 7% back into the other account, because again, it's going to grow at that bigger number. And so doing that, I wouldn't. If you're looking at pure economics, the problem is, we make financial decisions based on emotion, and we have to get past that. We have to understand how the numbers work. But the reality is, if I could finance out of my own cash or whatever else at 5% instead of paying 7%, I'm going to be better off if I'm dedicated to taking that differential and putting it back into that 5% account to pay that back. When people, the reality is, when people see, hey, when I paid cash, man, I have less payments. We can go out and eat more often. We can take trips. We can do all these things we wouldn't have done otherwise.
Totally.
And now then they're not any better off when they get out there in the future. They're worse off because they have a bigger hole that they've built. But really, it is the interest rate that makes the determining factor. And
Todd,
yes.
Don't you think we need to directly address the issue that Chris brought up about compounding versus amortizing, and a lot of paltering that goes on in that space?
Totally.
Well, we could. There is this idea that that the rate is different. There's this, you hear people talk about simple interest. That's not a real thing. Simple interest is the idea that you never pay interest on your interest, and there's always interest on interest if it goes beyond 1 year. So there's really no such thing as simple interest. But it's the issue that you get into, and why it's hard for people to get their head around it, is when we're dealing with rates, it's not. Nobody puts it into dollar amounts. Everything is a transaction on percentages. And so people think you can add and subtract percentages, and that's the differential between things. And in future videos, we'll look at that. Is the difference between 5% and 7%, 2%? Oh, no, it's way more than that. But that's the only way people can think about it, because we don't put it into dollar amounts. We'll do that and look at it. But the point is, if we're looking at the real picture of what's going on, and we want to be purely economic and understand, like I said earlier, we make decisions based on emotion. Not everything is a pure financial decision. But if we did, there's general guidelines that we can use to get us in the right area around rates. And it is, if I can earn a rate that is higher than I can borrow, then I should borrow.
Okay.
And the flip side is exactly the opposite. If the cost of borrowing is more than I'm earning, then I should pay cash. Now, that's pure economics. The reality is, in somebody's life, there could be some huge differences there. If I liquidate my cash, have I exposed myself to risk? Yeah, there's a reason that we have cash sitting around. There's a reason that investors, hey, get this. Warren Buffett, okay, right? So Berkshire Hathaway has currently a little over 29% in cash. Now, why would Berkshire Hathaway have that kind of cash? And Warren Buffett hates bonds, he hates cash, but he knows you have to have it to support the rest of it and make all the rest of it work out, right? So there are things that we do that don't look like straight at the numbers. Like, why didn't he do everything at just 12%? If you don't earn more than 12, everything they invest in is at 12%. Well, because we're entering a higher risk area. There's things that go up and down in there that if we don't have some padding, that stuff doesn't happen. So we have to look at the big picture, but the general guideline is, again, based on the rate. If I can earn more than I can borrow, more than the cost of borrowing, the rate of borrowing, I should borrow. And being in control of that scenario is what's really key as to where that happens. And, I know that's one of the things that's interesting with a life insurance loan as an example. If we have life insurance, are we in control of that loan? Yes, but is it the loan that gives us the control, or is it the cash value that gives it the control? And I think that's where one of the big differences is. And if we understand it's that cash value that gives us the control, it doesn't give us just control over a life insurance loan. It gives us control over every loan we have. Because we could literally borrow from, if it was more advantageous to use the bank's not going to let us skip a payment, right? But could we not borrow from the insurance company to make that payment if we had to? The same way we would do if we skipped a payment to insurance company?
100%.
So that cash puts us in control, and now we can make the best decision possible based on whatever the rates are from any financing option that we have, whether that's cash, using a bank, using a life insurance company, whatever that is.
Yeah, I think so there's two different conversations, and I maybe the next video we go into this next one. So if you're watching this, subscribe, hit the bell, that way you are notified when it comes out. But there's two different scenarios. Like, we're talking about like this from a pure economics perspective, and everything you just said, I 1,000,000% agree with, because of the fact that we're dealing with these depreciating assets, right? We're dealing with lifestyle expenses. We're dealing with things through the lens that we've talked about, so deeply in this video. What I want to talk about in the next video, maybe brush on it now a little bit, is what happens, because we do a lot of real estate investing, right? And there's power in the fact that if I can pay, and this is how I see it. So I'm curious to see how you kind of view it. There's power in the ability to say, all right, if I could take, let's say I need a $100,000 loan from policy, right, to buy a real estate property, right? And that real estate property cash flows enough, and I can manage the interest expense with the cash flow, right? And so that will be simple interest, right? Like if I'm paying the interest, like I take a $100,000 loan, the loan is 5%, I'm going to pay $5,000 a year for that loan. Make sense?
Yes.
Now, if I'm earning, let's call it 4% inside of the whole life policy, right? And that 4% is compounding in a non-direct recognition, that 4% is going to keep compounding at a rate. So now the next year I'm going to have 104,000 that the money is compounding on, and I'm still going to be paying 5% on 100,000. And eventually there's going to be a crossover point in the way that works. In like my policy is compounding, I'm paying the simple interest. Now, in your world, I get the economics of it. Like, it's what we do with the difference. It's like, it's always compared to what in all of it. But when we're talking about actual behavior and what people are doing with and how the money is flowing through their life, and the fact that real estate eventually is going to go up in value, and you are going to have like a windfall, maybe 10 or 15 years down the road of capital that you sell it and you can pay it back. And the question is, does it make, like, where is that break even? What makes sense? Because the different options to go get that loan, use a policy loan, then you have these fixed options. The real control comes from the fact that it's an interest-only loan, right? And you have complete control over those terms. And you could do that with anything. It could be a car, it could be whatever. And a lot of times that flexibility gets people into trouble too. So, that's a challenge, right? So you got to be who you need to be. And have the ability to manage all these different variables. But what do you say about the idea of like, if you're going to manage the interest only, yet it's going to be compounding, how do you reconcile that?
This needs to be a stay tuned until next video, because this is a very important point, and we need to address this properly and work all the way through it. I know you like to keep your videos short, so I'm going to encourage us to wrap up.
Okay.
And stay tuned for the next one.
All right, we'll do the next one. So, all right, so that little teaser, y'all. Kim's keeping us on track here. I like you. All right, let's keep going on this topic then.
Well, yeah. So I think, to wrap up what we've been talking about here is we have to understand the cost of things, and we understand that we can't get out of the cost. We want to minimize the cost as much as possible, but we have things in life that are going to be a cost, right? Yeah. Cars are going to be a cost. We got to have them. So how do we minimize that cost? And it's going to be looking for the best rate without exposing ourselves to risk on the other side. Sometimes we take on bigger costs when we understand what's going on. So we have, it's kind of like the English language, right? We have rules and we have exceptions. So why would a real estate investor ever pay 25% hard money for something? Because they got to get it across the finish line. And if they don't, they end up with zero. And if they do that, it's for a short period of time. So we're not talking about much interest anyway. And it gets the job complete and sold, and they actually make some money on it, right? So there are times when we violate the pure economics in order to step back far enough to see what the big impact is.
Totally.
Okay. And so really that's what we have to look at in our full circle and understand there's value for cash. Does cash cost us money? Yeah. And it saves us from having a huge loss.
And so it's a matter of how does it fit into the full spectrum plan. But this is the importance, I believe it's the importance of building your life from the bottom up and making sure that you build a foundation of safety before going out and taking on risk. Because that's why I always say, if you start investing in the greatest lie in personal finance, the younger you are, the more risk you can take. And it's like every good lie, there's a thread of truth in it because you have more time to make up the mistakes. But the younger you are, the less risk you have to take because you have this time on your side, and you don't have to take risk when you do that if you're just going to follow through with a plan, and if you do it the right way, you can get where you want to go with less risk, more control, more predictability, all these things, right? And that's really, I think, the difference between what we're talking about in these types of videos is teaching people to understand the financial principles that they need to understand to make good, educated decisions to get to where they want to go with predictability, not speculation, right? Because, people need to understand, like, words matter, vocabulary matters. When you save money in a 401k, you're not saving money in a 401k, you're investing money in a 401k. And there is risk that goes along with that. You have to think about all the different elements in life. The difference between saving and investing is just a function of risk. And what is the purpose of that money? There's a time and a place for both. It's not that one is better than the other, but the important part is structure. The important part is understanding different phrases. I use the phrase "the cost of capital" a lot because that's a phrase that nobody talks about in the personal finance space. And I think the reason they don't talk about it is because if they did, then their whole game would be up. Because people would be like, "Oh, that's the thing that I need to focus on more than anything else." Okay, yeah, like I'm going to do that. And all of a sudden, chasing rate of return is no longer the big conversation piece. I don't know. It's just me, but
you're right. And I think that's really important is you got to look at the big picture. You got to look at the whole thing. What would happen to a real estate investor that was investing directly in real estate and had absolutely no cash for, the potential of a vacancy or a capital loss of, having to replace a roof or whatever else? How long would they last? I mean, they might get lucky, right? And nothing happened.
They may have a good run, but if they keep operating with those principles, if they don't use the good times to, fortify the finances behind everything, well, then when times get tough, they're going to lose everything. We saw that in 2008.
Yeah. And we can look at it and say, hey, my real estate's doing 25%. Why do I hold cash at 3 or 4% because that 25% is dependent on it.
Yep, exactly. So, all right. Well, this is awesome, guys. So basically the conclusion here is buying a car every 2 years is basically, in this scenario, costs how much? 1.7 million?
Well, here we're doing it every 3 years. If we go to the normal of what we see, and again, not including kids in the mix, if we change that to every 2 years, like basically a couple trading their car every 4 years, we got a cost of $2 million.
$2 million.
Right. We shift that from every 4 years to every 6 years per person, which is the same as every 3 years for the couple, right? That reduces the cost by $700,000. And I love what you said earlier. This triples the average American's retirement funds, right? Most of them end up there at $300,000. We just added $700,000 to their $300,000 with that one simple thing. Again, I'm not saying you're evil if you buy cars every 4 years, whatever you want to do, but know the cost before you make that decision. And it's huge.
Massive. It's massive. Well, that's awesome, man. So, all right. Well,
You
so
need a stream deck.
Yeah, exactly. So next video, guys. So hopefully you found value in this. If you did, please like it, share it, get it out there. Hopefully you're enjoying this series. I'm going to put the link to the playlist for this entire series that we're doing. So if it's your first video that you can watch, I encourage you, go back to the beginning. We are doing this series in sequential order, really trying to do a financial principles series so you understand how this stuff actually works in your real life. It's not about products. It's not about anything except for understanding principles about how money works. That's really what it comes down to. The difference between money math and math math, and there is a difference. And, that's what it comes down to. Next video, we're going to get into this whole life insurance, the simple interest, compound interest. We're going to dive deep because that is one of the things that's talked about, I hear on so many videos, and it's so misrepresented. And, we can get into I'm sure we'll even get into the misrepresentation about like, oh, you're going to pay this and earn this dividend. And everybody always uses the declared dividends to use that as a number. And
Yep.
Know what I mean?
I hear you.
It's frustrating. So anyway, thanks for being here, guys. Todd, Kim, thanks, guys. You are amazing. And if you haven't already, once again, subscribe, hit the bell. That way you're notified every time I launch a new video. I'm going to put the link for the Truth Concepts YouTube channel as well down below, so make sure you go follow them there. And if you have any questions, comment. I'll do my best to engage with every single comment that I can. Until next time, have a blessed, inspirational day. Talk soon.
Thanks, everybody.